In President Donald Trump's second term, his administration adopted an aggressive and unpredictable tariff strategy, triggering significant economic and political turmoil. From imposing tariffs on key trading partners to abrupt reversals that rattled markets, this approach not only disrupted global trade, but also undermined confidence in the US dollar. This report delves into the administration's erratic trade policies, their immediate impacts, and the broader consequences of the dollar's decline amid escalating trade wars. The tariff escalation timeline. February 4, 2025, Trump signed executive orders imposing a 25% tariff on Mexican and Canadian imports and an additional 10% on Chinese goods, aiming to counter trade imbalances and national security threats. February 13, 2025, the Fair and Reciprocal Plan was introduced to address non-reciprocal trade practices, targeting Brazil, India, and the EU. February 27, 2025. A new 10% tariff on all Chinese imports was announced, citing China's failure to curb fentanyl inflows. February 28, 2025. The administration hinted at further tariffs on the EU and other key partners. March 3, 2025. In a surprising reversal, Trump suspended tariffs on select goods from Mexico and Canada to stabilize markets. March 4, 2025. The 10% tariff on Chinese goods took effect, prompting immediate retaliation from Beijing with 15% duties on U.S. agricultural products. Economic fallout and market reactions. Stock market plunge. By March 5, the Dow Jones Industrial Average dropped over 3,000 points in 2 days, reflecting investor anxiety. Dollar depreciation. The U.S. dollar index DXY plummeted 5% since early January, with a sharp 1% drop in 1 day due to escalating tariff uncertainty. Commodity volatility. Oil prices fluctuated wildly, with WTI and Brent crude dropping 3–5 in 1 week, while industrial commodities spiked amid supply concerns. Investor flight to safe havens. Gold reached record highs as investors sought stability, while the Japanese yen strengthened against the dollar. Business uncertainty. Many companies delayed hiring and investment due to policy unpredictability, further slowing economic growth. Impact on global trade and de-dollarization trends. BRICS and emerging markets. Brazil, Russia, India, China, and South Africa accelerated efforts to trade in local currencies, reducing reliance on the US dollar. Europe's shift. The euro overtook the dollar in extra-EU trade invoicing 52 vs 32, while European energy deals increasingly bypassed the dollar. Latin America's realignment. Brazil and Argentina expanded non-dollar trade, settling bilateral transactions with China in yuan and real. Russia-China financial integration. By early 2024, over 90% of Russia-China trade was settled in yuan and rubles, diminishing the dollar's dominance. The lasting consequences. Trump's tariff brinkmanship left a lasting impact on global trade dynamics and U.S. economic stability. The erratic nature of these policies not only weakened investor confidence, but also accelerated international efforts to move away from dollar dependency. With the fragile manufacturing sector, rising input costs, and mounting global skepticism about U.S. economic leadership, the long-term implications of these tariff wars continue to unfold. The second-term trade war under Trump reshaped the global financial landscape, amplifying economic uncertainty and accelerating a push toward de-dollarization. The unpredictability of U.S. trade policy during this period served as a cautionary tale showcasing the profound effects of economic nationalism on market stability and international relations. Whether these trends will solidify or reverse in the coming years remains to be seen, but one thing is certain: the world took note, and the U.S. dollar may never fully recover its former dominance.